Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcast.
Now, Jace, the rate of change is just starting to slow. Is that what it is? Like a MACD?
That's right. Yep, exactly. Your price action, again, the 12 and the 26 represents that longer-term price action, and so it's kind of a little slower with respect. It's think of it as a trend indicator, and it's suggesting that as the blue line is over the red line, you're in an uptrend as long as near-term prices continue to break higher than the longer-term prices. When you start to see that price action taper off, it's an indication that there's not as much interest in pushing to these higher prices. People are maybe not prepared to buy as quickly, so your closing prices tend to start to get a little tighter in duration or tighter in size, and so on and so forth. And again, that's actually telegraphed through this divergence on the histogram. And it also works the opposite way as you start to make your way into lows, lower lows. I didn't acknowledge it here, but you can see over here that as we started to play into these lower lows, one indication that we were possibly starting to exhaust this downtrend is the convergence, which is lower lows with our histogram moving higher. The convergence that's taking place, suggesting that, hey, wait a second, we may be meeting with some support in this particular area here. The next thing that we're going to look at to sort of, I guess, hopefully add a little more clarity with respect to choosing a directional bias is our relative strength index. And this particular indicator was developed by J. Wells Wilder. So sometimes you'll see, depending on what platform you're using, the RSI Wilder, and it doesn't mean that it's necessarily a crazier indicator to use. That was the guy's name. So it actually, that's kind of the original. There's been a lot of variations as we've sort of moved through the evolution of technical analysis. But the RSI Wilder is sort of that original indicator. Now, the idea is that what this particular indicator does is it compares stocks' gains and losses over a specific period of time, and you actually can select that specific period of time. The idea is that the information is calculated to reflect a number between 0 and 100. I'm going to show you an example in a minute here. But when the average gain is greater, your RSI rises, and that's suggesting that we have some significant momentum towards the upside. And, of course, the opposite is that when the average loss over that time frame is greater, your RSI is actually going to fall, suggesting that we're starting to pick up momentum to the downside. Now, a real simple way to use this, there's a couple of ways to use it, but a very simple and a little more conservative way to use this is the 50% line crossover. Now, what I mean by this is it's essentially known as the center line crossover. As I said, that there's a measure between 0 and 100. So really what we're doing is we're just adding a 50% line, and it's known, I guess, sort of technically as a center line crossover. And the idea is that a break above that 50% is used for a bullish momentum confirmation, and a break below that is used for bearish momentum confirmation. And what it can do is essentially, if it's trading above that 50% line and you're looking at maybe a possible bearish opportunity, you might be a little hesitant and look a little closer because you're still sort of trading in that upper range where momentum to the upside is still rather significant. And, the opposite obviously applies if you're trading in the lower range. If we look at a price chart here, here's a daily shot of the YUK, the U.S. versus the yen. Incidentally, we're actually trading. We dropped back down to this level here. We're now trading up into here as of today. But the idea here is that you can also see back here that we started to lose momentum on our RSI. Now, I've plotted a 13-day RSI here, so we're measuring the previous 13 bars or 13 days, And while our MACD is starting to show signs of crossing over, before that actually took place, you could see that this uptrend here is starting to lose momentum when we take the action on the RSI into effect. Now, in saying that, we can then look at our MACD crossover as sort of a further indication that this preceding uptrend is under some jeopardy. And then, of course, we want to look at our price action. And you'll notice here that this particular pivot point here coincides with this previous resistance level here, which now becomes support based on our rules. As it breaks below that previous pivot point or through that floor, if you picture that bathtub analogy, then we look at targeting lower lows. If we compare that breakthrough here with what has happened on our RSI, you can see that we broke below that 50% line, and while we've had a few sort of hiccups to the upside to test this now what's referred to as a resistance level, we still maintain our momentum to the downside, which to me means that be cautious of any sort of potential signals to the upside, because we're below that 50% line. Again, just to use this as an example, we crossed above, and as we stayed above, we were in an uptrend. When we cross below, we now start that momentum to the downside, and we have to be cognizant of the fact that any sort of moves to the upside, although the possibility for making some money is there, we might meet with resistance sooner than if we were still looking at targeting something to the downside. So what we're trying to do is again combine these various indicators. Now we're going to move into talking about just a couple of real simple patterns, and there's two types of patterns formations that we look at. The first of which would be our reversal patterns. Now, of course, with a reversal pattern, there must be an existing trend in place. The first signal is a break of a major trend line. So all of these sort of concepts that we've been talking about with respect to identifying, trends and key support and resistance levels, we're actually applying to trading off of these patterns. One thing to note is that the larger the pattern, the more significant the move. So the longer it takes for a market to find resistance or to find support, the more significant, once they've actually made that decision, the move is generally going to be. What's interesting is that topping patterns usually are shorter in duration and a lot more volatile than your bottoming patterns, and the reason being, again, those of you that have taken part in our seminars, you'll know that I always use the analogy of a burning, of being in a room and somebody yelling fire. Picture everybody long the U.S. dollar, and all of a sudden, there's a little sign of smoke and somebody yells fire. Our natural reaction is to run for the hills and assess the situation, from safety. And so what tends to happen is when we're at risk of losing our hard-earned capital, we tend to, at least for the most part, we should be more focused on preservation than on sort of assessing the situation. And so these topping patterns tend to be a lot more shorter and more volatile. And I mean, you only have to look at how the overall market has been trading as of late to recognize that, generally when people are comfortable with the markets, you don't tend to get 500-point drops on the Dow or 40-point drops on the S&P in one day. So, conversely, when we look at the bottoming process, bottoms tend to have smaller price ranges and take longer to form. And of course, the reason is, once the market has traded off and it's separated a significant number of people from their capital, there tends to be a little apprehension. And think of it as kind of dipping your toe into water where you're not sure the temperature. Most people will start slow, test the waters first before they jump in, and so these bottoming patterns tend to take that much longer to form and have smaller price ranges as people test the waters, before they jump in.
Thank you for listening to our podcast.